The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very good morning and warm welcome to Squawk Box Europe. I'm Juliana Tadabon with Karen Cho and Steve Sedgwick, and these are your headlines. U.S. President Donald Trump signs off a new federal funding package, bringing an end to the longest government shutdown in history. The president slamming the Democrats over the costs involved.
Today, we're sending a clear message that we will never give in to extortion, because that's what it was. They tried to extort. The Democrats tried to extort our country. This cost the country $1.5 trillion, this little excursion that they took us on.
The Stock 600 logs another milestone with benchmarks across the continent rallying, while the FTSE 100 approaches the 10,000 mark as fresh data just crosses the wires on GDP. We'll get the numbers shortly.
Plus, Siemens is called lower despite posting record net income for the third year running as quarterly industrial profits miss expectations and the firm reduces its stake in Siemens Healthineers. Speaking to CNBC, the CEO, Roland Busch, strikes an optimistic tone.
We have quite a strong outlook in a difficult environment because we still have geopolitics, we still have tariffs, but we believe we can grow in that space.
We have GDP numbers out of the UK at this point, and let's get straight to what we're seeing. The print is 0.1% for the 3-month on-month figure. This is lighter than expected, 0.2%. The view is, do we have some pre-budget jitters creeping into the economy, as we've had a lot of news flow ahead of what the Chancellor Rachel Reeves could be doing. That is one effect economists have been looking for this morning. The UK September GDP number of minus 0.1% month on month. That is a retreat, obviously, seeing a contraction for that month of September. A poll thought we would be flat over the course of the month. If we break this down, the third quarter preliminary GDP is at 1.3% year over year versus the second quarter. That was a clip of 1.4%. So clearly a slowdown here versus the prior quarter and also versus expectations. On a quarterly basis, as we look at that level, 0.1%, the market was expecting 0.2%, also a slowdown from the previous quarter. Let's get to the details. Services output 0.2% month on month. So again, that was still expanding. Construction output 0.2%. Manufacturing output minus 1.7% month on month. And industrial output was down. Don't forget there were some issues with Jaguar Land Rover. They had a suspension of production for a month that may have impacted the numbers today.
Thanks, Karen. Look, there's been an almighty rally on markets this year. The FTSE 100, our producer just sent a 10,000 watch email out as well. So we're watching for the sustainability of the rally. We're also looking for sustainability of the rally on companies that have had a stonking great move to the upside. And with that in mind, I've just got a CEO laughing in the wings here. I'm talking about Aviva, which the shares are up 48% so far this year. And when you get into the higher ground, when you get into thinner air, every tiny detail is poured over by the investment community because they want to see whether they are justifying these big rallies or actually whether the valuation is yet to re-rate to the level where the CEOs keep telling us they should be. And we'll be told to in a moment. Look, there's a big statement out from Aviva today, third quarter trading update, and the CEO's already told me there's 3 big things to look out for. One, that they're on track to achieve their 2026 group targets 1 year early. 2, they're raising their ambitions with a 3-year group targets, a new set of targets as well, and announcing upgraded cost synergies and quantifying capital synergies from direct line acquisition. Operating EPS is up 11%. AIM, anyway, 2025 to 2028. That's a CAGR, compound annual growth rate as well. There's a lot in there as well, but I think we should get straight to Dame Amanda Blank, who I'm delighted to say has joined us around the set, who is the CEO of Aviva. Amanda, always lovely to see you. Thank you for joining Karen,
Good to
Juliana,
see you.
and myself as well. And I noticed you've got your barbs into me already off air saying, I don't know how the ladies put up with you, which is how I like it, as you well know.
I know.
So, Amanda, tell us about the numbers.
Yeah, no, look, thanks for having me on. So on the quarter numbers, strong trading performance, good growth in our general insurance business. Wealth flows up 8%. So, really, really strong performance in the wealth platform, which is the biggest platform in the UK. We've got over 220 billion of assets. But I guess the big news today, Steve, as you just said, was, the three things. We're going to close off our 2026 financial targets, and we'll say that we will be achieving those targets 1 year early. So that's £2 billion of operating profit and £1.8 billion of own funds generation. And then, having obviously had the opportunity to own Direct Line now for a few months, we're raising our ambitions on the Direct Line deal. So we're increasing the cost synergies from 125 million to 225 million. And we're also announcing for the first time the capital synergies, which everybody's been waiting for, of greater than 500 million. All of that leads to a new set of group targets. And so we're putting our targets on the same footing as our peer group. So 11% CAGR, as you said, on the EPS, greater than 20% on the return on equity, and over 7 billion of cash remittances. So, we're in such a good position. Trading momentum is really, really good within the business. And we're ready for the next chapter of Aviva, I guess.
Yeah, and look, there's so much to ask you about. And luckily, I think you've been very generous. We're going to get you for about another 8-9 minutes as well. Look, I've been studying Norwich Union for a long, long time.
Gosh, now you are going back in time, right?
Exactly. And various CEOs all the way down the line. One of the things that previous CEOs did, and funny enough, as I said to you, I was talking to a grandee of the insurance industry the other night about you, and your ears would have been burning, is Amanda's done a lot of the things that those previous CEOs should have been doing. They simplified the business, they concentrated on the markets where you were 1, 2 or 3 in those, and got rid of all those assets where you just weren't going to get scale. Has that broader journey with the Direct Line completion, has that moved to a final phase, or actually is it ongoing?
So I think it's really interesting. I always believe that if you're a 1, 2 or 3 in the market, you've got a real opportunity to win. And, I think that really, really matters. So, we've really focused on that. We did a lot of the things, as you said, the previous people talked about. So we sort of did the doing. But I do think that with Direct Line, we now move our operating earnings to 75% capital light. So, what does that mean? It means less capital, better returns, more operating profit. So it's a new stage of the journey, and I think that we've been taking the business on the journey. If I reflect, in 2022, the operating profit of the business was 1.35 billion. And now, we'll say it's 2 billion for the end of this year. We've returned 10 billion pounds to shareholders. So with the share consolidation and with dividends. So I think that, it was all hidden in plain sight, really. Yeah. Everything was there to be done. A lot of people are good at producing PowerPoints, aren't they? You've got to actually get things done, I think.
When it comes to the integration of Direct Line, it seems like it is really going well. When you look at what you've revised today, now expecting to achieve £225 million in cost synergies, nearly twice the original estimate. What has gone better than expected, and where are those synergies coming from?
Yeah, so first of all, I think, when we announced the 125 million, that was a sort of accounting number, and we were going through the takeover process, so that was a bit muted. But actually, we have done better. We've seen that there's more to be gained from the operational synergies, the head office synergies, and also the technology synergies. The capital number we didn't announce last year, but clearly what you're doing is you're bringing in a personal lines business into a wider general insurance business, so you get a level of diversification benefit from the capital there, and then you diversify with the life company and you get an additional diversification. So the synergy numbers are a brilliant number, and it means that that should be new news to the market today, and it should surprise on the upside, we hope.
And you mentioned buybacks and how consistently you have been able to deliver cash back to shareholders. How should investors think about buybacks now moving forward?
Yeah, so we basically have said, and we say in the announcement this morning, that we will return to the share buyback in March 2026, and the share buyback will take into account the increased share count following the deal. So, we had been doing regular and sustainable 300 million. We paused it this year whilst we did the deal, and that will return, but also take into account the share buyback. So, it's good news for investors. And we've also added another 5% to the dividend to take into account the deal. So our dividend policy was also enhanced, when we announced the deal last year.
Amanda, let me turn to the macro and the operating environment that you're facing right now, because the data that has just landed this morning as we've kicked off the conversation suggests a slower pace of growth in the third quarter. 0.1% is the clip. In fact, the ONS is now saying for the third quarter, GDP growth per capita was 0. So no progress here. Do you think it's just pre-market jitters, or are you witnessing that there is a fundamental slowdown in the UK economy?
So it's really interesting, because I think what we see with the flows onto the wealth platform is good consumer confidence. People are saving, but insurance is an incredibly resilient business. If you think about what we've been through over the last 5 years, a cost of living crisis, supply chain, inflation, COVID, the businesses continue to perform. So people don't tend to stop saving. They don't tend to stop insuring their motor, their home, their businesses. So I think that, what we are seeing clearly is some nervousness. So what we have seen in the last few months is people are ringing our contact centre and saying, what should I do with my tax-free lump sum? And we have seen a slight elevation in terms of some of the flows with people taking their tax-free lump sums. Honestly, I believe that the 26th of November can't come soon enough. I think, every week we get a new view of what may happen with the budget. That's not very helpful. I don't think it's helpful for consumers. It's not helpful for businesses. So I think it'll be really good when we've got some certainty, because you can deal with certainty. What you can't deal with is speculation.
You've mentioned businesses and you've mentioned consumers in two different buckets. And the reality is the weight of the fiscal position fell on businesses and some of the initial Labour Party measures. Now we're talking about shifting that onus to consumers, and the most painful measure being a high income tax. And that has well and truly been discussed at length before the budget. If that was to pass an extra 2p, would that have consequences even for a resilient insurance business like yours?
So I genuinely actually don't think so. But obviously we're always conscious of what our consumers are going through. But if you think about even the inflation numbers, what they've seen, and Steve was telling me about the increase in his motor insurance premium, which have reflected, which was always nice to discuss, obviously.
Mine went down, so I don't know what that
you're
says.
Obviously a better risk, right? But I think that the consumers have dealt with quite a lot over the last number of years. What I would say is, what we need to make sure of is that in some of the measures, if you think about things like salary sacrifice, that is not just going to be an impact on employees, that's also an impact on employers. So you could have a double impact should, there be changes to the national insurance charge on salary sacrifice. So I think we've got to be very, very careful about the unintended consequences of measures in the budget. And so we are really, we're very keen to see what actually is going to happen.
What's your sense about the direction of travel of the UK economy with what's been floated that we could hear in the November budget? You just hit on some of the things that have been put out there, but are you optimistic, generally speaking, about where the UK is headed?
So look, if we think about all the foundational things that you need for to be optimistic, a government talking about growth, a strong regulatory backdrop. You've got some real changes in regulation, certainly for us on things like targeted support, which will help our business, Solvency UK, which will help our business. All of these, and then, investment in infrastructure, which we obviously invest in. All of these should be things which should come together and produce a good outcome. The pensions bill, planning reform. I think the problem that we have is that everything is coming, there's a little bit here, a little bit there. What you need is to see this all joined together and to see what the actual impacts are going to be over the medium to longer term. I think that vision of what all of that together means for the economy, means for you, us as consumers, us as businesses, that's not there at the moment.
We had a conversation with the man you probably know him, Clemens Jungsthöfel, who is the CEO of Hannover Re, and we talked to him last week about increased risk and the modelling for that risk, and of course, the models are getting more and more sophisticated as we go on as well. Do you have concerns that we are underestimating the amount of increase in risk to homes, to property, coming from climate, and actually modelling for that is getting more and more difficult?
So I think we've always said that climate is a risk to, if you think about insurers, we think about this all the time. And I'm sure that's what your guest was saying. We are modelling for flood exposures. If you think about the UK, and in Canada, we're thinking about, hail, fire, flood, whatever, you get all of these events. We're constantly modelling on that basis. We've got, very many actuaries that spend all their time doing just that, Steve. So I don't think it's a new thing. I think we've always assumed, particularly if you think about the UK as is very, very prone to flood risk. It does not take much bad weather to create a flood event in the UK. So we're always thinking about that. But now I think we're thinking more about mitigation than we are about actually, it's not about stopping the risk, it's about how do you build back better so that you're more resilient should these events happen.
Let me ask the predictable AI question, because there have been lots of concerns in the marketplace around valuation, and that is based on some disappointment in the application phase. So the question really is what business is doing with this tremendous technology, whether it's delivering returns and whether you see the value in it. How would you describe your adoption of AI and the benefits you're getting out of that investment so far?
I'm amazed it's taken us that long to get to AI. I mean, so honestly, we're very excited about the opportunity with AI. If you think about Aviva, we have nearly 25 million customers, and we have, very many repeatable processes. So if you think about AI, there's applications right across the business. Where we've seen the cases to scale up are in areas like claims summarization, where we're making the experience for the customer a lot easier, a lot quicker. We've got that live with 500 claims handlers at the moment, and in areas of underwriting, so things like medical underwriting, where we're taking very, very complicated doctor's note, consultant's notes, and we're presenting it to underwriters to be able to make decisions, and we're saving 50% of the time of the underwriter in underwriting the risk. If you think about those things and you compound them across Aviva, one of the benefits of a diversified business is when you're putting AI investment into the business, it's not just for one product, it's for very, very many products for Aviva. We see that there is real opportunity and benefit. Are we at that stage yet? No. But are we in the scale-up of some of those opportunities today? Yes.
Amanda, I read a lovely piece from Jonathan Malls and others at the FT about you. I thought it was a very nice piece about you. But one thing, there was an ex-Aviva executive criticised the lack of succession planning over at Aviva as well. I know you're not going anywhere soon. I hope you're not going anywhere soon. But is that a criticism which you take lightly or quite seriously, or how do you feel about that?
Look, I think it's total rubbish. If I look at my exco, I have got, and I will say this, to them all, the best exco that there is in the insurance industry. And I've got really strong CEOs in each of the businesses. So I thought it was interesting, and I thought it might actually be an ex-Aviva executive, but who knows?
Let's be honest.
There are a few of those.
And also, what I loved in the article, it said you're not one of those chummy Leadenhall Market Club people as well. Although one of those chummy Leadenhall Market people club the other day said some very nice things about you to me as well. We always love speaking to you.
Thank you.
Thank you for your candid answers, and well done. With everything that's going on, it's great. Dame Amanda Blank, who is the CEO of Aviva.
U.S. President Donald Trump has signed a funding bill into law, ending the country's longest ever government shutdown after 42 days. The bill was passed by the House of Representatives on Wednesday, with 6 Democrats joining the majority of Republicans in support. The bill funds government operations until the end of January and reverses all shutdown-related layoffs of federal employees. Key economic data releases are also set to resume ahead of December's Fed decision. However, the White House has said several reports, including October's CPI print, may not be released ever. Speaking before signing the bill, Trump slammed the Democratic Party, blaming them for the shutdown.
Today, we're sending a clear message that we will never give in to extortion, because that's what it was. They tried to extort. The Democrats tried to extort our country. In just a moment, I'll sign a bill exactly like we asked Democrats to send us all along. Many days ago, this cost the country $1.5 trillion, this little excursion that they took us on. Republicans never wanted a shutdown and voted 15 times for a clean continuation of funding. There's never been a time when one or the other party ever didn't sign a continuation. It's just a continuation, not a big deal. It's a continuation, and we'll talk later. Yet the extremists in the other party insisted on creating the longest government shutdown in American history, and they did it purely for political reasons.
Speaker of the House Mike Johnson outlined the consequences of the shutdown for Americans.
We feel very relieved tonight. The Democrat shutdown is finally over, thanks to House and Senate Republicans who stood together to get the job done. Absolutely no question in anybody's mind now that the Democrats were responsible for this. What happened? Millions of American families went without food on their table. You had millions of Americans stranded in airports with their flights canceled and delayed. You had troops and federal employees wondering where their next paycheck would come from. The Democrats openly admitted They openly admitted, many of them said it in their own words, that they use the American people as leverage in this political game. They knew that it would cause that pain to the people, and they did it anyway.
Coming up on the show, the longest ever US shutdown has officially come to an end, with stock markets at record highs. We'll break it all down. Plus, UK third quarter GDP comes in soft in a blow to the Labour Party, while rumours swirl over Prime Minister Sir Keir Starmer's future just 2 weeks out from the autumn budget. Ritika will join us to discuss. And Charlotte is in Paris, focusing on all things luxury. She'll be speaking to the CFOs of Prada and EssilorLuxottica.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Burberry marked a return to growth in the second quarter, with comparable store sales rising 2%, beating expectations. The British luxury brand says it's still in the early stages of a turnaround, flagging challenging macroeconomic conditions. Let's get out to Charlotte. She's at the JP Morgan Global Luxury and Brands Conference in Paris. A terrific lineup today. And Charlotte, you're about to have one of the fantastic conversations that luxury customers enjoy having. That is luxury at a discount for those who've ever been to Bicester.
Yes, absolutely, Karen. Scott Malkin, founder and chair of Value Retail. So you have, Karen was just talking about Bicester, just outside London, one of these villages. There is an outlet where you can get some luxury for a bit of a discount there. You also have La Vallée here in Paris. So just, you benefited post-pandemic and the cost of living crisis. You had buyers looking for better value, and certainly going to outlets was a way to do that. So can you just draw for us the trend for you? Is it continuing now going into 25 and going into 26 as well?
Sure. We were lucky in that we are a bit of an oasis, always attracting people to break them free from their normal lives. Maybe they come from halfway around the world, which is often the case, or maybe from just across the road, but we want them to feel a sense of relaxation, safety, and comfort when they're with us. And that mattered a lot during the pandemic. And since then, ironically, it still matters a lot because there's such chaos in the world. People are so emotionally caught up in events. So the pattern for the brands, who are our client, the guest is the client of the brands. The pattern for the brands is very complex right now, and the guests can feel that because in the end, you know, they say in sports, the bench never lies, at least in ice hockey. So the customer, the client, she really knows the difference. And the brands today need to speak with confidence and with conviction to win over that shopper, that loyalist to the brand.
So I guess a lot of villages are outside cities, so you have to make an effort to go there. So I guess once they're there, they probably will spend some money because it takes that effort to go there. So I guess you have to make them go there. So how do you create that, I guess, that marketing, that traction for customers to actually make the effort to go to those villages?
The guest has evolved quite a lot in our history and is now fundamentally a traveling luxury consumer, a long-haul traveler. And our word of mouth is the most authentic. Editorial is the next most authentic. So we try to stay away from advertising per se and create more of this sense of a destination linked to emotion, discovery. The price offer, we would term it as value for money, not as discount. The distinction being quality and very correct relationship with the merchandise, the guest. And our primary purpose today is the acquisition of new, appropriate full price customers for the brand. So the customer discovers the brand, maybe rediscovers the brand, and is exposed to merchandise. Each of our brands we invite to have a limited presentation of full price currencies and bestsellers to give the best impression of that brand. So when that woman goes back to Doha or Dubai or Delhi, she takes away the item that's a bit of a trophy, but she bought it at full price, because today most access to the brands is digital. And what we know is that shopping online, there's no soul, there's no emotion, there's no joy. And so the brands respond to that by creating a flagship experience. It can be at the airport, it can be on the great shopping streets of the world, or it can be in our villages, but there are relatively few physical touch points that allow a brand to define itself and to build its brand equity.
Yet what we hear from a lot of luxury players in particular is that they're controlling the distribution more tightly over the past couple of years, cutting the exposure to wholesale, some are cutting the exposure to outlets. What does that mean for you in particular in terms of brands that want to be present in your villages?
So this notion of control is fundamental to protecting and building brand equity. The reality is it's very inconsistently applied. So what is said is not necessarily what's happening, and one can go online and find examples of dumping. The stock used to go behind the Iron Curtain, now it goes onto the internet. It's the same mass market logic. What we're trying to do, complementing the brand's full price distribution, is create moments of recognition. The brand, what it accomplishes, whom it addresses, why it matters. And so we work very hard with the brands so that when a guest, when a customer comes into that boutique, she recognizes the values, the identity, the characteristics of the brand that make it special.
So you're a potential bridge to the aspirational buyer to a certain extent, because a lot of them have been squeezed out from a lot of these luxury brands. You pitching that you actually can be a bridge to this aspirational buyer.
Yes, we would say particularly the aspirational buyer who will become a full price customer again in a different moment, or will become a full price customer for the first time, discovers the love of a product, the love of an identity, and says, well, I'll commit to that. So we're really serving the woman who embraces brands rather than is fashion forward or a fashion victim, which is a different psychology.
Can I ask you about your expansion plans? Because most of your villages are in Europe. You have 2 in China and 1 newer one in the US. So which market are you looking at for further expansion? Are you going to look at doing more villages in the US or in China?
We are following the brand. We serve the brand. As I mentioned, they are our client. They are our core reason for being. So if the brands are expanding more in China, we'll focus there. That's why we went to China. Brands asked us to go because they wanted the correct presentation of authentic surplus. Now a lot of brands have said they are shifting a focus towards the US, which is an underserved market, much less densely addressed than Europe, for example, for these global brands. But the US is confusing right now. Tariffs and it's an unfamiliar world, and also what's happening in California may not have very much to do with what's happening in Texas. And again, comparing that to a city that, or cities that European brands have been most comfortable with historically, Boston because it feels very European, Manhattan because it's a global hub. So how the brands will grow in the US is, I think, fascinating. The fact that they will expand their businesses in the US is certain. So we are likely to continue to serve those brands there. Always we want to work as a direct partner with the brand. We don't have a real estate model. We're not a shopping center logic. We're a department store, traditional carriage trade department store logic, licenses on brand royalties on their sales. So I think for us, the project we have opened outside of Manhattan near JFK is the 12th. And the projects happily are all successful. The ones in China are going very well right now in this climate. But the opening of Belmont Park Village is the strongest in the history of our business. Part of it is it's on a 430-acre campus alongside the first third-generation sports and music arena in the world, UBS Arena, the revitalized Belmont Park Racecourse, which is under construction right now, and will compete with Meydan to be jointly the focus of bloodstock and horse racing in the world. Right. But the metrics, the performance, the quality of the guest is faster and more powerful than anything we've seen. Right. So that suggests again that in the US there's an opportunity for the brands, right, and we're happy to serve the brands in that way.